Boom! I told you last week that the market was going to drop, and it did. It collapsed. Wow, what a week. What an important week. This particular issue of TradeSmith is going to be a very important one. Hey, Courtney Smith here with our weekly video newsletter, TradeSmith, bringing the hammer to the markets for over 45 years. And this disclaimer has been bringing the disclaiming to you for, well, maybe a little bit less than 45 years, but still important. Listen, this was a big week, and the coming week is going to be also important. I've got to tell you what's going to happen here. Now, first of all, fully paid up members, you saw the great hedges that we put on here. So this drop in the market, it didn't mean anything to us because we had hedges, we had short positions on, we were rocking and rolling. But here's what's going to happen now. As you can see with the S&P 500, the market was winding up in that rectangle formation that I've been talking to you about for 3-4 weeks. I also, last week, the key thing that I told you was the purple predictor collapsing. Look at that thing, just collapsing. And I said that the purple predictor was suggesting that the smart money was already selling the S&P futures, the Dow, not the futures, the market. And sure enough, it took a week or so after the purple predictor breaking down that finally on Friday we gapped down, plunged below that rectangle formation on increasingly heavy volume. That means this breakdown is legit. Now, the real question, of course, is how far is it going to go? Because so what did I do? Well, last week I talked about a couple of different places. The first thing I did is I talked about getting down to around the 2110, 2120 area here on the S&P 500. Well, that sort of falls into the duh category now, and we should probably reach that on Monday. However, the real question is, where do we go after that? Now, if we go from basically just under 22 down to 21, that's only 100 S&P points. Now, 100 S&P points, that's a decent correction. Okay, on a 2,000 instrument, that's 5%. But I think this correction is going to go further. I think we're going to see maybe, let me be honest, maybe somewhere between 4 and 10%. I'm not sure we're going to get down to 2,000, but let's go through some of the indicators, and then I think you'll see where I'm going to come out on this decision. You've got to be hedged. I told you to do this last week. Get short some stocks, lighten up on the long side. If you didn't do it yet, you got to do it now because this is going to continue to move lower. There's no reason to believe that this little bear move is going to turn around anytime soon. By the way, there's also no reason to believe that this is going to be a bear market. A bear market is defined as a 20% correction in the market. So you can still ignore the doom and gloomers. But a normal correction? Sure, of course. We had one in January, February. We're going to have a normal one right now. And then things are going to take off. Let's dive more deeply into it. Here's the Dow. I had been highlighting to you how the purple predictor had broken down at the end of July. It didn't do it in the S&P. It was very normal in the NASDAQ, but it had really collapsed in the Dow Jones. And that's why I've been harping on this idea of we've got to stay away from the big Dow Jones stock. We were better off in the technology stock, but I like to use the S&P as the best proxy for the market. Here's the NASDAQ, also collapsed down, but you can see the purple predictor is actually held up very well, which tells us that there are certain sectors in the market that are collapsing and more weak than other sectors. And we know that because the big Dow Jones stocks, the big boring stocks there, the purple predictor collapsed a month ago, then just in the last couple of weeks in the S&P, and really has yet to collapse in the NASDAQ. And so that means we've got to be picking our spots here. In fact, fully paid up members, you'll see that some of our stocks were up on Friday. That's fantastic. Making money on our longs, making money on our shorts. Whoo, doesn't get any better than that. All right, seasonality. Our seasonality indicator also cracked down, not as bad as the Dow, but still did. So where does that leave us on our scenario here? Well, once again, go to the beginning of September there, and I'm really sticking, I think, to the blue line. That's the second from the highest one. That's all presidential election years. We've now begun right on target, the very beginning here, or middle of September, exactly when seasonally we're supposed to crack down. And you can see we're cracking down. We'll probably continue to move lower into the early part of October. Now, the green line was one of my secondary preferred lines. I really felt the blue line, which is all presidential election years, was the most preferred scenario. And the simple reason was it has the most data behind it. So when you have the more data behind it, it gives you more confidence that that's going to happen. That's just all presidential election years. The green line was a number 2 pick. The green line is the incumbent party wins. That means Hillary wins. And then the purple line is no sitting president running. Once again, a secondary choice. But it's really only the top 3 lines that I consider to be valid at this point, because the price action has been running perfectly along with those 3 lines. It has not been running with the black line, so we can completely ignore that one. Theoretically, it could be the yellow line, but so far the price action has fit the blue line the best. So I'm sticking with that scenario. It's worked out very, very well. It's really been a great roadmap for this year's price action. Yield curve, still capping gains, but you can see coming up in January, it gets even more serious. Asset allocation, surprisingly, did not really move on Friday. So now this data could be a little bit old, but it should be right up to date. So what can I say? The stock market risk indicator actually went up. They moved into riskier stocks. Well, we already know that because we saw that the NASDAQ type stocks held up, whereas it was the Dow stocks that went down. And really what this is saying is that therefore the market actually moved out of boring stocks into riskier stocks. Very interesting behavior here. Global stocks, which had broken out to the upside, they just turned right around and came right back down. So listen, we can't look for a safe haven in global shares. Japan, technically still a bull market, but don't want to be involved here at all. Let's just stick in the U.S., which is still the strongest big market out there. I've been talking about Greece. Don't want to be in Greece anymore either. Let's get out of there. Now, this was exciting to me. I love trading bonds. I've been trading them since they started trading them. Well, not cash bonds, futures bonds. But I've traded literally billions of dollars of bonds and really love the market. Here's the line that we put in last week. And I told you that if it broke out of the top side, I was going to go long. If it broke out of the bottom side, I was going to go short. It broke out of the bottom side. So you should be short bonds right now. You could short TLT. That's this ETF I'm showing you here. You could buy a put on TLT. There's many ways you could have gotten short. It also happened on heavy volume. So the volume confirmed the breakdown in the bond market. What does that mean? Higher interest rates. When bonds go down, interest rates go up. They're inversely related. So critical. Now, our key indicators, I got 2 of them suggesting lower interest rates and only 1 suggesting higher interest rates. But once again, as what we've been saying for a long time, the most important indicator affecting treasuries right now is the blue line, which is the yield on 10-year treasuries in Germany. And look at that. It's saying higher interest rates, and that's exactly what we've got. Now, the dollar had a lot of movement as well. Here's an uptrend line. I'm bullish on the dollar, but I got to tell you, I can't get excited about trading it. I like to go where there's action. Here we are, we're trading the same prices we were in March. This is boring, okay? Look, you can make money trading the dollar right now in a short-term basis, but there's no real position trade here at all. So I'm going to say I have a bias to the upside, but I don't really want to trade it, and I don't have really any interest in trading it. However, this is affecting the price of gold, which I do have an interest in trading because I think we can get some big moves in here. So you can see that the gold market, it had a nice rally early in the week and then kind of petered off at the end. Now, I look at this chart as kind of a mixed chart. Clearly, it's a bear market, but it's a really slow-mo bear market, right? We're making lower lows and lower highs, but boy, there are not really significant lower lows and lower highs. So when I look at a sluggish movement like this after a pretty explosive movement in June and into early July, it tells me that this may just simply be a big flag formation and that what we're seeing is just a consolidation before it breaks to the upside. But then I'm like a two-handed economist here. But on the other hand, we have the dollar generally moving higher, and the dollar tends to move inversely with gold. So that kind of suggests that, no, maybe this sluggish bear market is really what gold's going to do. Now, all of this is over the short run. I'm still a big bull in the long run. But my job is to make money, not to make huge pronouncements and then lose money. That's what gold bugs do. And let's be clear. I am a gold bug in terms of I wish society had gold-backed currency, but I'm not a fool, and I don't buy and hold forever because that's not the way to make money in gold. The way to make money in gold is to pay attention to current market conditions and get long sometimes and get short sometimes. All right, our indicators. I didn't put my usual arrows on here because I'm not sure if they're bullish or bearish. You can see that we went down from the middle of August in most of these indicators. Then we hooked back up a couple weeks ago, and then we hooked down a little bit just in the last few days. So I'm going to have to say I'm kind of neutral here too, and that confirms what we just saw in the chart, in the price behavior. Oil, here's the way this is. I'll tell you how this is going to play out. We're in the middle of two big conflicting things. The first is we have huge supply. Record-setting supply. That's bearish. But on the other hand, when we saw prices get down below 30, the production was choked off. And one of the things, and demand, of course, increased because it was cheap. So jet fuel, airlines took off. So what's going to happen is this. If the price of oil gets up around, let's say 55, 60, you're going to start to see the spigot of production start to ramp up. There's a lot of production that can be turned on quickly. And then there's a lot of production that can be turned on slowly. But the point is, it'll tip it back into the bear territory. The bull side is, of course, every year we always see an increase in the demand for oil. As the world's population goes up and as countries get richer, they demand more energy. And still, after everything that's been said and done, oil's still the cheapest form of energy for most people. Coal, sometimes, and a few times it's wind and solar. But oil is easily transportable. It has many advantages over the other ones. So then what's happened is that in the last year, the whole oil industry has simply not reinvested at all. Capital expenditures shrunk to basically zero. And so as a result, that's created a situation where we're going to see a gap. And the gap is going to be that at some point we're going to see production start to go up if prices go up. But then it's going to get stuck at a certain point, and we might be able to get up to $60. We're not going to get up to $100. That's not going to happen like in my lifetime, okay? There's just too much oil and not enough demand to get it up to those high prices again. We're going to have a Middle East war or something like that, a huge supply disruption to get those super high prices anymore. But on the other hand, I don't think we're going to go back into the high 20s. We're just going to go between, let's say, 40 and 55-ish, something like that. Maybe into the high 30s and low 50s, something like that. So frankly, oil's become into that category of boring. I don't really want to trade it too much anymore. We finally found a fair price, and we're going to stay around this $45 area, I think, for quite some time, between 40 and 50. Hey, listen, really important week. You've got to keep your hedges on. You've got to be only putting on small size positions if you do get long. This is not an environment for the brave. This is Angels, we got to be angels, okay? Fools rush in where angels fear to tread. And we need to be an angel right now because the market is under pressure. It's going to remain under pressure for the next several weeks. We could see a 10% correction altogether in the market, something in that area. Maybe a little bit less than that. Hard to evaluate because we're only one day into this correction, really, maybe 2 days. We need a little bit more evidence, and we'll get that in our next TradeSmith. But please, look, I'm not a doom and gloomer, but I'm telling you the market's going lower right now. It's going lower. So act accordingly. We're going to get some great bargains coming up in a few weeks. I'm really excited about this down move because I'm positioned for it. I was ready for it. I told you about it. Now our next big move is going to be figuring out when to be a buyer. We're going to build value back in this market. This is a really good thing that's happening. I hope you're positioned, though. If you're not positioned, it's a bad thing. But you can get positioned on Monday. So please, this is an important TradeSmith. Pay attention to what we've been talking about here. And of course, if you're not a fully paid up member, this is probably a really good time to become one so you can keep on top of the specific recommendations that I recommended to our super cool paid up members and the short positions that we put on, which have been doing great. All right, everybody. Thanks very much, all you freebies. We love having you here. Wish you were paid up members, of course. Paid up members, hang on. I got to get into the specifics of this. You're going to love this.